Hey everybody, it's Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 8th, 2024. How you doing? I hope you're doing well, and thank you for coming and visiting for my weekend review podcast. The format of the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what were the setups, what were the confluences of signals, why did I enter, and then most importantly, we're going to talk about my process of how I'm going to manage the trade going forward, whether it goes in the direction I want it to or if it goes against me. Of course, once I put on the trade, I have no control over the market, but I do have to have a plan. I do have to know exactly what I'm going to do regardless excuse me, of what the market's going to do. And really what that comes down to is being impatient with my losers and having a process and being patient with my winners. You need to make, in the long run, you need to make more money than you're going to lose. You're going to have losing trades all the time. I have them all the time. And that's okay. The key is that you have to keep them small when you're wrong. And like I said, have a process that can let them ride if you are right. It's really important to have a plan, really important to have a process to know, because otherwise, from day to day, we just may have an impulse of, oh, that's good enough, or, oh, I think I'm going to stay in even though I shouldn't. In the long run, you're going to make a lot more money and your trading is going to be a lot easier if you have a plan. So I'll explain what my plan is, and hopefully that is going to be helpful for you. And if it is helpful, if you find value in this podcast, I really would appreciate it if you could hit the thumbs up button. Helps build the channel, helps keep the channel around, lets YouTube know there's some valuable content. After we go through the trades, we're going to talk a little bit about trader psychology. Always an important topic. Really the most important skill in trading is the ability to create that plan with good trading techniques, good trading principles, but most importantly, being able to follow that plan. That's really, really the key, and that comes down to trader psychology, so we'll touch on that. After that, I have gone down through my master watch list last night on Friday, both on the daily charts and the weekly charts, and I have identified some potential entries for next week if and only if those markets get to those levels that I'm looking for. It's important to be patient, let the trade come to you, let it come to levels that make sense. And what levels am I talking about? If we're talking about deep dip buys, we're talking about 300-day moving averages, 250-day moving averages, 200-day moving averages, 30 RSI levels, maybe looking for a V1, a V2, maybe we're looking for a bullish fair value gap, maybe we're looking for a bearish fair value gap. But unless a trade gets to where you want it to go, unless a trade gets to a location that offers you an edge, why get in the trade? Then it's just a 50-50 proposition. We need an edge, we need a mathematical edge to tell us at this location, more often than not, it's going to go our way. Not every time, but more often than not. And that's really all we can ask for. Put the trade on, position size correctly. If we're right, having process to stay in the trade. If we're wrong, quickly getting out, just letting it go and waiting for another trade setup. So I have identified those both on the daily and the weekly time frames. They're not quite there yet, because if they were there, I probably would have already taken the trade. So we'll go through those and we'll take a look at what I'm looking at next week. Okay, let's get started. Let's run the U.S. legal disclaimer. Hang tight. I'll be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast. here, and here. Thank you so much.
All right, let's get started. This is FXY. This is the Japanese yen. I did enter the Japanese yen back here on the 20th of May. Why did I enter there? Well, you can see to the left, I have this bar highlighted with green. This is what's called a bullish abandoned baby. An abandoned baby is as follows. You have a gap down followed by an immediate gap up. So why is this important? This is important because for some reason the sentiment was very negative and then immediately very positive. I really like these approaches. They don't work all the time, but they work more than they don't. And that's what's key. So I so these are called the bullish abandoned babies. When it gapped up here, I didn't buy it immediately. I would like to have had a better risk to reward ratio, and so I waited for a bit of a pullback until it came back and filled the gap. So I got long here at 59.24. Now with abandoned babies or island reversals, and if you'd like to learn more, just go to my YouTube channel in the lessons playlist under abandoned babies, island reversals. I have a nice video there that will explain in detail how I use these. But when on these particular trades, I set a pretty easy set it and forget it type of profit and loss scenario. What I do is I place a 2 ATR stop to the downside if I'm wrong, and I place a 4 ATR profit target to the upside if I'm right. So if I'm right, I'm going to make twice as much as if I'm wrong. Okay, and in my experience, just about over 70% of the time, these are profitable. So that means 70% of the time, I'm going to make twice as much as I'm going to lose. But again, there's 30% of the time it's not going to work. And so I bought here 59.24. It just kept going down, and then boom, we had a nice move up, finally got positive on the trade, and then right back down. So this one's been a little bit frustrating, but again, it's a set it and forget it kind of mentality for me on this particular trade. If I'm wrong, I'm going to lose 1% of my account. If I'm right, I'm going to make 2%. But again, about over 70% of the time, in my experience, these come in with the profit instead of the loss. So currently down on the trade about 0.41%, so not too bad. But I do want to highlight over here, here was another gap down followed by a gap up. And then as we came back down and filled the gap, I got long here, same procedure as over here. I placed my 2 ATR stop below, placed my 4 ATR profit target above, and you can see initially it went against me for a couple days and then raced up and hit that 4 ATR. So I really don't know what's going to happen here. Of course, we never really know. All we could do is have a plan, but my plan here is I'm either going to lose 1% if it gets down to my 58.40. I'm going to make 2% if it gets up to the 60.96, and we shall see. So down 0.41% on this particular trade so far. Intel. All right, so Intel, I did get long here back on the 31st of May. Why? Well, we are working on a double bottom bullish divergence here, bullish MACD divergence, showing that we were running out of sellers to the selling momentum to the downside. And then we have this nice V1 and bullish engulfing bar here. And when it triggered the V1, I got long at 30.29. So these are a little bit different trades than the island reversals or the abandoned babies. And with these, the first thing I do when I enter the trade is I always put that 2 ATR emergency stop. That's just what, I mean, you have to look at the worst case scenario right off the bat. Okay, so always 2% below my entry if I'm long, 2% above my entry if I'm short. That is my emergency stop. If I ever get there, I'm simply out of the trade. Now, the next thing we have to look at is what is my end of day stop? Well, my end of day stop on this particular trade is if we close below these previous lows here at 29.73. Most of the time, 95% of the time, if you're wrong, it will be because you trigger your end of day stop. 5% of the time is if you hit your emergency stop, right? So the emergency stop doesn't happen very often, but you really do have to have it. I hit a couple of them over the last couple of weeks. Doesn't happen doesn't happen often, but it does happen. So you have to have that worst case scenario there. So again, entered at 30.29, place my emergency stop 2 ATRs below my entry. My end of day stop is going to be a close below 29.73. Now to the upside, I have the orange line here. This is my trailing stop level. This is 1.5 ATRs above my entry. If I do get to that location, now I go into what's called trailing stop mode. It's moved far enough that I don't want to give it all the way back. So once it gets to 1.5 ATRs, if I have a close below a previous bar's low, I will exit half of my position. In addition, everything I've talked about, the emergency stop, the end of day stop, getting to trailing stop level, these are all considered defensive moves. I also like to play offense in my trading. Offense is taking partial profits when it moves the value of 0.45 ATRs from the previous day's close. So right now, the previous day's close is $30.74. The 0.45 ATR reading right now is 0.37%. I would add 30.74 to 37 cents. That will be my first profit target on Monday. I'll take my first profit target, add that value again. That becomes my second profit target. Take my second profit target, add it again. That becomes my third profit target. So I always have 3 standing limit orders in the system for each new day. And if I do get to one of those profit targets, I take off 10%. And it achieves a lot of things. One, it reduces your overall position size. You lock in profits that the market can't take it away from you, and your position size gets lower. And the lower your position size, the easier it is to stay with your process. So profit targets to me are really invaluable. And like any good sports team, you have to play offense and defense in trading. At least that's how I feel about it. And it's worked well for me. So, interestingly here on Intel, we have a double bottom bullish divergence forming. We haven't quite tested this bottom, but even if we do, this will be a double bottom bullish divergence. And really all that means is you're running out of selling momentum. And if you run out of selling momentum, the implication is that you will probably go up. I don't know. We shall see. But what's really interesting here is this sideways motion that we have. Extreme sideways motion. What does this mean? Well, all this means is that there is a balance, an equilibrium of buyers and sellers. And I always teach, in my one-on-one courses and in my podcasts that sideways motion is what leads to trends, and trends lead back to sideways motion. So I can assure you, Intel here is going to move strongly one way or another. Don't know when, but it will. But whether it's down or up, I don't know. But sideways motion always eventually leads to strong moves to the up or the downside. So I like the sideways motion. Hopefully it will go my way. We'll see. And if it doesn't, I have a plan, right? So back to the partial profits. So entered here, actually took some partial profits by the end of the day because it did move up 0.45 ATRs. And then back here on the 4th of June, the next day we had a big move up, also took some partial profits off there. So I've already taken partial profits off at profitable levels, reduced my position size. But this particular trade, currently the remaining shares that I have from entry to current price up 1.43%. And then Google was a short position that I took here on the 5th of June. Why? Well, let me bring your attention to this highlighted blue bar. This is the highest up close before we have a break in structure. So we were definitely in an uptrend. We changed structure. Now that we've changed structure to the downside, a move back up into this order block is a shortable area. So on the 5th, when we got to the bottom of the bearish order block, I know this doesn't look bearish because it's up, but it is bearish because it was the highest up bar before market structure changed to the downside. I did get short here 175.80 when it got to the bottom of the order block, because anywhere within this order block, if you check back into that order block, that is a shortable area. It doesn't mean it's going to work, but that's the idea of the strategy. So my stop now is going to be my initial stop, my end of day stop is going to be a close above the high of this bar, of the high of the order block at 178.10. So in the future, if it does close above the high of that order block, I'll simply get out. Of course, I have my 2 ATR emergency stop above, as always, because I'm short. And then I have my 1.5 ATR trailing stop level to the downside. So if it does continue down and get to my 1.5 ATR trailing stop level, then I'll go into trailing stop mode. And all that means is then in the future, if it reaches that area, then if I have a close above a previous bar's high, I will exit half of the position. So this particular trade, the next day just kept going up. On Friday, it kept going up. I was like, man, I am just dead wrong on this particular trade. I thought I may get stopped out, but then we had a nice reversal on Google by the end of the day. And so far, this particular trade is up 0.87%. So those are the open trades there. FXY down 0.41%, Intel up 1.43%, and Google the short up 0.87%. Okay, let me show you the closed daily trades. Well, this is very similar to the Google trade that I took, ITA. Again, blue shaded area is the highest up bar before structure change. When it got back to there, I got short at 135.60. My stop is a close above the highs here. My 2 ATR emergency stop is here. I got short, and I'll show you why it's so important to take profits, partial profits, when you have them. So I got short here, 135.60. By the end of the day, it had moved down profitably enough for me to take 10% of my position off. So I locked that in at profitable levels. Next day, we moved down again, which was nice. I hit 2 profit targets, so I took 20% of the trade off at profitable levels. And we also got to trailing stop level, which means now if I have a close above a previous bar's close, I'm going to get out of half. Next day was up, but didn't close above the high. The next day we had a huge move up here. This obviously closed above this high, and I did have to get out of half of the trade for a very small loss, 0.35%, but you'll see why that was important that I did that, because the next day we went up, we went above my stop, closed below it. Next day went above the stop, closed below it, and then the very next day it did close above my stop. And on the second half, or the remaining shares that I had, I took a 1.3% loss. So does that mean overall I took 1.3% loss on the trade? I didn't. It was less than that because of the process of taking partial profits when you have something, the offensive part. So I was lucky enough to take profits here. I was lucky enough to 1 profit target here. I was lucky enough to take 2 profit targets here. And then my process with the close above a previous bar's high, taking off total half of what I had remaining, was very important, even though it was a very small loss. But you can see this, if I had just stayed in the trade without maneuvering at all and taking profits, I would have had a 1.3% loss, but it was much less than that because of the partial profits and because of the trailing stop rule that I had of getting out if we close above a previous bar's high after reaching trailing stop level. So anyway, actually really quite surprised at the strength of this, because this started off really good. This was a really good setup for a lot of reasons, and a little surprised, but the market is very, very strong for shorts. So a loss of 1.3% on the remaining shares there. And then the same thing, almost exactly the same thing with SPY. Here is your order block, highest close before market structure change. When we checked back to the bottom of that order block, I got short at 528.90, but then we had a big down move where I was able to take off one profit target at least, which is important. It's better than nothing, right? Because the next day was up a little bit, and then after that, on the 5th, we closed above the order block, and I simply had to get out. So that was a really a frustrating trade. But with shorts right now, it is really frustrating because the market is just so strong. I mean, this was a really good setup. I was very patient and waited for this. There were all sorts of confluences here, but it just goes to show you, it just doesn't matter how many confluences you have. There are times when they don't work. So on this, a loss of 1.07%. So on the closed trades, the remaining shares on ITA loss of 1.3, and then on SPY a loss of 1.7. So those are the daily trades, open and close. Let's go over to the weekly trades. Well, this is probably going to look familiar to you, right? Here we go. This is on the weekly bars. This is Meta. We have the highest up close before market structure change. So the market structure has changed to the downside. So the way that I trade is if you've switched from uptrend to downtrend, you should short rallies. And that's exactly what I did. We closed in the order block. I got short at 492.96, was actually exactly the closing price, so totally unchanged. My stop's going to be a close above the high of this order block. My end of week stop, in this case at 532. I have my 2 ATR emergency stop above me, and then I have my 1.5 ATR trailing stop below me. So if in the future, if we go down to this, of course, I'll take partial profits on the way down. If we get down to that, then I'll tighten up my stop by having the rule that once I get to this level, if I have a close above a previous bar's high, then I will exit half. If it just continues down, I'll just continue to take profits on the downside. So this one completely break even. And then IBB, been in this trade for a little bit. I did get into this trade. Really good setup. I mean, it's almost exactly break even at the time. But I did get short here at 136.69. Why? Again, we have the bearish order block to the upside, which is followed by a market structure change. We've rallied back up into that bearish order block. But in addition to that, we also rejected the 200-week moving average. So this just added another signal to this by rejecting the 200 at the same time we're within this bearish order block area. So I did get short here, 136.69. My end of day stop or end of week stop, simply a close above the high of the order block. I have my 2 ATR emergency stop up here. I have my trailing stop level orange line down here. So the next week it immediately went up, but closed below the 200. Oh, excuse me, everybody. I wonder why I didn't have the line there. My end of week stop is not a close above the high of this order block. It's a close above this 200-week moving average. Like, why don't I have my line there? But I forgot. We have a 200 here. So my end of week stop is much tighter. It's just a close above this 200-week moving average. Next week, we did get above it, but closed below it, kept me in the trade. The next week after that, we did go down. And remember, if it goes my way, the value of 0.45 ATRs, I'm going to take some profits. So I did take some profits 2 weeks ago and reduce my position size, lock those profits in as it moved down. This week, we did, during the week, get above the 200, but currently we close under, keeping me in the trade. So this one is, I mean, it's literally break even within a few cents. So, so that's it. So on the weeklies, Meta completely unchanged. IBB basically break even as well. So, it's been really challenging for the shorts. There have not been a lot of good deep dip buy candidates to get long. And in this particular market right now, as if you're following it, you'll know, really the indexers are being dragged up by the Mag 7 stocks. The market breadth really is not good because, yes, the indexes are at all-time highs or near all-time highs, but the majority of stocks outside of the Mag 7 are down. And that's not a good situation for the market. It's not a healthy thing to have the indexes only drug up by a handful of stocks while the majority of stocks are going down. So that's called market breadth. So for as traders, as swing traders right now, it's difficult because things are the stocks that are going up very high. They don't offer good risk to reward ratios. There are a lot of potential short signals, valid short signals, but they really haven't been working because it's just moving up. And then the deep dip buys on the stocks that are at those levels don't seem to be bouncing. So, this last month, from a trading perspective, has been quite difficult. I've been holding my own, but it's been quite difficult just because we have this kind of bipolar market where a handful of stocks are going straight up and are very high, and the rest of the stocks are down and not really doing anything. So it's been challenging, but that's the thing with trading. We don't always have perfect market environments, and the key is we really just need to be patient and wait for good setups. And if we decide to take those setups, if they go against us, just go ahead and get out. But there's not always like a perfect Cinderella Goldilocks uh, um, setups for us to always have. And this last month, from a trading perspective, it has been difficult. So really, the best thing we can do is just wait and be patient. That's good. That's good advice always with trading as well. Let's talk a little bit, and actually on that topic, let's talk a little bit about trader psychology or some general, trading words of wisdom. This is from Mark Minervini, of course, very, very famous author and trader, and he always has good advice. So let's see what Mark has to say today. And you can follow Mark at Mark Minervini over on Twitter or X. And Mark says, "This is my strategy on every trade I take. It never changes. The key to consistent trading success is to make every move one that starts with getting odds on your money and then progressively improve your worst case scenario to create an asymmetrical leverage that doesn't mean the use of actual leverage. This sentence is worth millions of dollars. So the key to consistent trading success is to make every move one that starts with getting odds on your money." Okay, let's break that down. What does that mean? Well, I always talk about how important it is to have a good risk to reward ratio. Take the 200-day moving average, take the 250-day moving average. It's a great deep dip buy strategy where that is your line in the sand. You know, if it rejects the 200-day moving average, I'm staying in this baby until it closes back underneath. If it does close back underneath, then I'm simply out for hopefully a small loss. But that's your line in the sand. Above, I'm in. Below, I'm out. And that's what Mark is talking about as far as getting odds on your money. Odds on your money means you're going to make more if you're right, less if you're wrong. And what an easy way to tell whether or not you're in the trade. I'm above the 200. I'm out if I'm below the 200. If you're out and it gets below the 200, okay, you're out for a little bit of money. If you get in above the 200 and then it has a huge move up, well, that's getting odds on your money. That's why a risk to reward ratio is so important. That's why I always try to buy as close to my line in the sand as possible. So, and then progressively improve your worst case scenario to create an asymmetrical leverage. Well, all he's saying there is improve your worst case scenario. So as it moves up, moving up your stop. Well, when I take partial profits, every time I take a partial profit, it does. I am moving up my stop, right? Because I'm taking off part of the position more and more and more. So that ultimately is moving my stop up, and it's improving my worst case scenario at all times. And then, having your trailing stop level, getting to certain important levels, resistance levels above, and knowing when to get out. This is all why it's so important to have a process, everyone, that takes all these things into account. But he's right. The key to consistent trading is to make every move one that starts with getting odds on your money. So if you're right, you're going to make more than you're wrong, and then progressively improve your worst case scenario to create an asymmetrical leverage. And that's taking the profit, taking partial profits. That's having um, like going into trailing stop level and getting out of half. It's really, really important. And that's why, when I have a trade and it moves in my favor and then I get out, I'm fine to get out. A lot of people say, well, why are you getting out? This, in 2 or 3 months, this could be much, much higher. Yeah, it could, but I would rather take the money that I have made and now go back and reinvest that into a new trade that has a good risk to reward, a better risk to reward ratio. Does that make sense? So anyway, Mark, I appreciate you making this post. It really is important. And please follow Mark over at Mark Minervini over on Twitter. All right. Let's get to potential trades for next week. Excuse me. Like I said, if you're enjoying the podcast, if you're learning anything and value to you, if you would hit the thumbs up button, I would really appreciate it. Also want to mention here that I do teach private one-on-one lessons in the evening time. I think the best way to learn anything is one-on-one with your instructor. I've taught people from all over the world, and I love to teach. I think I'm a really good teacher, and my students have been very happy with their teaching. And in my course, it's 15 hours. I teach you all the different trading approaches that I use. I teach you step by step exactly how to do them. When you're done with this course, I promise you'll be a better trader. And so if you're interested, my email is in the link of the description. The course does cost $1,750, but it is really worth it. It's worth every single penny. And so if that's of interest to you, just reach out to me, and we can talk about scheduling a call. Okay, let's get to Alibaba first on the list. Oh, and by the way, I have 10 symbols here. Theoretically, all 10 of these symbols could trigger on the same day. That doesn't mean I would take all 10 trades. I would narrow it down to the very best trade. And how would I do that? Well, which one has the most confluence of signals? Which one has the greatest market relative strength? Which one looks best on multiple time frames? These is very important, but I just have had a rule in the 28 years, almost 29 years now that I've been trading, to narrow it down to the one that has the best report card, the best risk to reward ratio, all the things that has the best chance of going my way. And again, this is what I teach to my students as well in my one-on-one course. So let's start with Alibaba. Okay, well, black line here is the 200-day moving average. I was just talking about that as far as a good line in the sand. Generally you are going to have buyers, institutional buyers, large hedge funds, things like that, that will key off of the 200-day moving average. And again, it's such a good line in the sand. Hey, I almost bought this on Friday, but you can see it did not quite get to the 200. So next week, if it does bounce at the 200, or it goes below the 200 during the day and then closes above the 200 at the end of the day, that would be a rejection. Or it might even close under and close back over. But any three of those scenarios, I might potentially get into Alibaba. If it had a V1 or a V2, that would be, extra bonus points as well. And by the way, if you'd like to learn more about V1s, V2s, I use them so often, especially in my swing trading, also in my day trading. Go and look at my lessons playlist, V1s, V2s. I think you'll like that video. But I don't know exactly what's going to happen here, but this is the area. You can see last time we got down to the 200, this is kind of where it stopped, right? We were straight down until we got to the 200. You can see here, look at this one. Went below the 200, closed above, gave you a nice opportunity for a trade. So we're not quite there. A lot of times that 200-day moving average will act as kind of a magnet. The market will want to test that, but some kind of rejection next week on Alibaba, I would consider getting in this trade. A V1 or a V2 would add extra bonus points. So we'll see what happens, but we are getting to an important level here on Alibaba. Walt Disney. Well, Walt Disney has not, look at this, unbelievable. Straight up, straight down. Well, let's look the last time we were the 200-day moving average, all the way back here in January. Look at that. Close under. Oh, I took this trade. Yeah, I remember I took this trade off of the 200 because it went below the 200, closed above the 200. Like Mark Minervini said, it gives me a good risk to reward ratio. If it would have just closed 1 penny below, I simply would have been out. But look what happened with this trade. Great trade with a great risk to reward ratio. Well, look, we're kind of getting back to that 200. Does it mean that it's going to do what it did all the way over here in January? Certainly not. It certainly doesn't mean that. But looking back in time and it respecting the 200-day moving average, it doesn't hurt. It just means that the market so far in the past, it has respected the 200-day moving average. So, this is still down here at about 97.54, so it's not quite there yet, but you can see what's forming. You see the lows we have here with the deep red MACD bars, then we rally into green. Now we're coming back down, trying to challenge this low. No red whatsoever on the MACD bars. So this means that the selling momentum, at least from a MACD standpoint, is starting to run out. And the implication is if you run out of sellers, that you may be moving up. Not sure. I'm not going to buy it right here, right now, but if we did get down to this 200-day moving average, that would really make a lot of sense. That 200-day moving average also dovetails with the negative third ATR channel here. That is important as well because 92% of prices when it gets to the negative third ATR channel tends to stop going down or move up. And you can see the confluence is right here. So right about 97.65 is an area that I would be looking long to get long, Disney DIS here. And, if it rejected the 200-day moving average, then I know exactly what I'm going to do. If it closes below the 200, I'm simply going to get out. If it starts moving up, then I'll start taking my partial profits. And if it gets to my trailing stop level, then I'm going to trailing stop mode. But it's just, again, it's just having that process. And, whether you learn your process from me in my one-on-one lessons or you learn them somewhere else, doesn't matter, but it's important that you get yourself a process so you know exactly what to do regardless of what the market does. But this is what I'm looking for on Disney, some kind of rejection of the 200-day moving average. Home Depot, okay, well, again, the Mag 7 are going up, 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 and companies like Walt Disney, Home Depot, down, 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 down. But we are getting to some kind of important levels here again on Home Depot. Same as with Disney, we have a low here with deep red MACD bars. We rally into green. Now we're coming back down to challenging these lows. We don't have any red MACD bars, so we are starting, this is pretty decent. We're starting to have double bottoms with bullish divergences, and we are at major moving average support levels. So right now, what I would really be looking for is it to come down and challenge this low. That would dovetail with the 300-day moving average. The 300-day moving average is at 319.62. So maybe 8 points to the downside, but that would give, if it rejects the 300-day moving average, that would give a very, very good risk to reward ratio at a very reduced price. Doesn't mean that it has to hold that 300, but again, it just gives you a good structure of the trade to key off of that 300, and especially because we have this double bottom bullish divergence forming. So that's what I'm looking for, some kind of rejection of Home Depot at about the $319 level. INDA, oof. Man, look at this. This is incredible. I mean, this was back here on the 3rd of June. We made all-time highs and then just simply collapsed the next day. I mean, I don't think I've ever really seen anything that dramatic of, I mean, talk about an abandoned baby. We went very bullish to the worst bearish in the world. So we had great news followed by horrible news. And now look at this. We're all the way right back up. Unbelievable. Up, down, up. I am looking for a short. If we close the gap at the bottom of this abandoned baby right here, 54.59 is what I would be looking for a short. If it does get there, then this is one of those trades where I would just put a 2 ATR stop above and a 4 ATR profit target below. But serious abandoned baby here. My favorite place to get short or long on abandoned babies is when it closes the gap. So we had this big gap down. So right here, 54.59 is the area that I would be looking to get short, but we need to get up to that area first. And if it does, again, if I take the trade, 2 ATR stop to the upside, 4 ATR profit target to the downside. Microsoft. Okay, well, here is our highest close before structure change. So anywhere in this red area here is a shortable area in the bearish order block. What I am keying off of here is the 429.50 mark because one, it's inside this bearish order block, and two, it's halfway of the big down bar that preceded the order block. Halfway of a big down bar is also going to add some uh, uh, resistance to it as well. So it's a confluence of signals of being a check back into halfway the big down bar and also in the overall bearish order block right here, 429.50. If we get to that area, I will consider taking the trade. My stop would just be a close above the highs here, 2 ATR emergency stop to the upside. So that's really what I'm looking for, is to get short around 429.50. Bonds, TLT. Well, we had this is a bullish abandoned baby. We got down, followed by an immediate gap up. This is a bullish pattern, and you can see it did work quite well. We had some employment news that came out on Friday that drove yields up and bond prices down. I would really like to buy TLT if we come back down and fill the gap on this bullish abandoned baby. I don't know if it's going to get there. It looks like it's a long ways away, but if we had 2 or 3 days down, it could get there, and I think that would be a really good location, right about 89.41. So that's a couple dollars below where we are, but I think that would be a very good location. You know, you can look back at TLT. Let me highlight it here again. Here is a bearish island reversal. Worked. Bearish island reversal. Worked. Bullish island reversal. I took this trade. Gap down, gap up, hit my 4 ATR profit target. Here again, bullish abandoned baby. That worked. So they work really well on bonds, but this is one I have to really be patient. And if it gets down here and closes that gap, 89.41 on that previous bullish abandoned baby, I would certainly consider getting in there. And then simply easy, 2 ATR stop, 4 ATR profit target above. Natural gas, UNG. Well, 200-day moving average here, key level of resistance. Bullish abandoned baby here too, by the way. Worked out pretty well. We got right to that 200 and failed immediately. That's where the selling came in. Well, then we moved down. Now we're moving back up again. Well, perfect confluence here of the 200-day moving average and the third ATR channel. Right in here is the place that I would be looking for a short. It rejected it last time. Doesn't mean it has to reject it this time, but I would much rather get short here than here because one, it's going to be lower high, and two, you have the third ATR channel and confluence. So next week, if we do continue to move up on natural gas and reject the 200-day moving average, I would consider getting short. I place my 2 ATR stop above for my emergency stop, and then my end of day stop would just simply be a close above the 200-day moving average. But I do like this particular trade, but I still need a rejection of that 200 first before I get short. But that's definitely a possibility for me next week. The dollar, UUP, again, highlighted blue bar. This is a bearish order block. It's the highest close before structure change. So if we do get back into this order block, the highlighted red area here, I would definitely consider getting short on this particular trade. If next week, if we rejected the bottom of this order block here, if we rejected it, I would consider getting short right there. If it didn't reject, if it went into the order block but didn't reject it, I probably wouldn't get in until it had some kind of reversal inside of the order block. Last scenario is if we do go up to the top of the order block and then reject it, that would be my ideal, because then of course my risk to reward ratio is going to be best, because then if it just closes, a little bit over that, then I'm simply out. So, but this is an area I'm looking for. But with these order blocks and fair value gaps, sometimes I have to look for what the price action is inside of these. It's not like just one line like the 200-day, which is much easier. Hey, I'm in above, I'm out below. So I have to look for a little bit of a price. So I'm just kind of giving you the values and the zone that I'm looking at. But so somewhere between 28.86 and 28.69, I would be looking for a short. VIX. Okay, VIX is really, really quite interesting here, folks. And especially if we overlay it against the indexes, the SPY and the Qs, which I'll do a little later in the podcast. But this is called the double bottom bullish divergence. Here we have a low, here we have lows with deep red MACD bars. This just means that we had strong momentum to the downside. Then we had a rally, we have green bars. Now here we are, 11.11. This is a double bottom bullish divergence. We went lower than this previous low, but you see how we have no red bars whatsoever? This is a perfect example of a double bottom bullish divergence and a missing right shoulder. Missing right shoulder because we don't have any red. This is about the strongest MACD reading divergence that you can get. All this really means is, even though we're going down, 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 from a MACD perspective, there is no strength to this down movement. So this is very bullish for the VIX and therefore bearish for the markets. Another thing I want to show you, look at the lows here. Look how deep the RSI level was. It was below 30 RSI. Now we are lower than we are over here, and we're at 34.88. This is called a RSI divergence. So we have a double bottom bullish MACD divergence. We have a double bottom bullish RSI divergence, and from an ATR divergence, this is the one ATR, or -1, -2, -3, -4, -5, -6. At this lows, we were at the -4 ATR channel. Now we're lower. We're at -1.5. This is the trifecta of divergences for VIX. That's very bullish for VIX and therefore very bearish for the market. So just because we have these bullish divergence, all these divergences in place, it doesn't mean I'm just going to go ahead and buy the VIX. I still need a signal. And a signal could be an under 30 over 30, possibly a higher low V1 or V2. But this is very extremely bullish for the VIX right now. And like I said, bearish for the market. So, and a little bit later, we'll take a look at the indexes and you'll see it's the opposite of this. So looking for a higher low V1 or V2, possibly on VIX, or if we go lower, an under 30 over 30. And then last but not least is XLE. Well, XLE, never was going to go down. Now it seems like it's never going to go up, but we are getting to an important level. we're getting to the 200-day moving average, and that 200-day moving average also dovetails with the negative third ATR channel. This is a decent place to buy. I was talking about, for buying Apple and Nvidia and, Meta and all these other company stocks that are way, way, way high. Yep, the headlines are great. It all seems great, rah, rah, rah. But from a risk to reward ratio, it's not good up there. And you look at the overall technicals of those, it doesn't look good. They keep going up, but the technicals are starting to fail and paint some warning signs. So that's why I've been looking at, Disney and Home Depot and things like this, something that has a little bit more reasonably priced and technically getting towards some key levels. Well, XLE, which is Energy Select, is definitely getting there. So the 200-day moving average is what I'm looking for next week. Possible rejection of that 200-day, a bounce, intraday rejection, close over, close under. That could be a potential area for me to buy that as well. So those are the dailies. Let's take a look at the weeklies. Okay, AGQ, silver, on the weeklies. Well, we had this huge move up on silver. Huge, huge, huge. Well, trees don't grow to the sky. And we have had quite a big pullback. I mean, AGQ was down 8.55% just this week. Well, let's look below us. Are there any potential areas here? Yeah, the 200-day moving, or it's the 200-week moving average, the black line. Very simple, nothing really technical to it. Next week, if we bounce at the 200, or we intra-week, if we continue down, go below the 200, then back over, or close under, close over, potential entry on silver. Pretty simple. I mean, yes, you would expect, with this big a move, we'd have a bit of a pullback, but if it pulls back to a key area that gives me a good line in the sand, consider taking it. Budweiser, same thing. We had this huge move up on Budweiser. What's below it? Well, 200-week moving average. Look, last time it closed over the 200, did really, really well. Look, last time we closed under here, over 200, did really, really well. Does it mean it's going to work this time? No, absolutely not. But it puts the odds in your favor that every single time it respects the 200. I mean, it has in the past, in the recent past, it has respected that 200 and bounced at the 200. So doesn't mean it's going to do it this time, but it puts the odds more in your favor. So again, just be clear on Budweiser. Next week, if we do go down, reject that 200 week moving average, that would be a potential long entry for me. And these are all deep dip buys. When you come back down to the 200 or come back down to the 250 or come back down to the 300, those are key levels where buyers come in. Oh, and by the way, I was talking about my one-on-one course. That's the ideal thing to start with, right? But if you're not in a financial position to take the one-on-one course, a really good alternative is I have a video course at udemy.com, and the link's in the description, where I teach you step by step how to trade these deep dip buys. And deep dip buys are some of the best. They're really the easiest because they're really easy to key off these moving average. But it's a great course. I've sold so many around the world. I think it has like 4.8 or 4.9 stars on it, and it's super affordable. It's depending on the day on Udemy. I've seen it between $15 and $40, but it's 9.5 hours of video. There's 26 videos, 15 study guides. So that is a really, really good course. And, if you're not in the position to take the one-on-one course, that's a great, great, great place to start. And the link's in the description. So keep that in mind. So Anheuser-Busch here, 200-week moving average is something that I'm interested in. Russell 2000, IWM, again, deep dip buy. Look back here on the 8th. Close under, close over the 200. Good risk to reward ratio. Worked out fine. Here was a bounce at the 200. Worked out fine. Back here on the 19th of April. Came down to the 200, rejected it. Rally. Worked out fine. So if we come back down to that 200-week moving average again, I would consider getting long there. It's not there yet. I mean, what are we at? 201, 194. So yeah, I mean, it still has to drop 5-6 points to get there. Will it? I don't know. But if it does and rejects the 200, well, I would consider taking the trade. But that's the key about being patient and just waiting for it to get there. It may not get there. It may just go up next week and we don't get there. But, I look at these things on the weekend and say, look, this is the area that I would be okay with buying it. If it gets there, great. If it doesn't get there, then I just go on to something that does get there. So on the IWM, the 200-week moving average, McDonald's, oof, again, tale of two cities in the market, right? Tech and the rest of the world, just straight down. This 200-week moving average would be an excellent risk to reward ratio to get long McDonald's, without a doubt. Doesn't mean it's going to work, but for one, it's so oversold, and for two, there is a very good chance that you'll have a group of buyers coming here at the 200-day moving average. And more important than that is now you have something to key this trade off of. If it closes under the 200, I'm just simply out. I can wait for it to close back over to try it again. But if it rejects the 200 and I get in, it could have another move right back up, just like over here. But it's all about risk to reward. Buying at a key level, 200-week moving average on McDonald's is a key level. And then if I'm right, being very patient with the winner. If I'm wrong, being very impatient with the loser. If it loses the 200, I could try it at the 250. If it loses the 250, I could try it at the 300. Eventually it's going to bounce. I don't think McDonald's is going to go out of business. You never know. But the first level here below us is the 200-week moving average at about 230. So it's 256 right now. May never get there. I don't know, but if it does, that would be my location. And last but not least is Tesla. Well, the last major moving average it respected was the 300. This is the orange line. Close under, close over. So far it's held that. If we pull back to that 300 and reject it, that's would be my entry spot, potential entry spot on Tesla. So I hope that was helpful, everyone. If you have any questions or comments, please put them in the comment section. I'll do my best to get them. Oh, I'm sorry, I forgot. Let's take a look at the indexes. Okay, here's the SPY. I kind of want to show you this. I'll show you both on the daily and the weekly. But I was making the case on the VIX with the double bottom, all the double bottom bullish divergences. Well, let's look. Sorry, it's busy because I have my other stuff up there. But look, here's the SPY. Look at the high here we had with the tall MACD bars. Then we pull back. Now we're higher here than we were here. Even though we're higher here, look how small the green bars are. This is a double top bearish MACD divergence. Here at this high, we're at the over the about 2.25 ATR. Now we're higher. We're only like 1.5 on the ATR. RSI, we were higher here. Now we're higher in price and we're lower here. So these are all bearish divergences on the indexes. Let's take a look at the weeklies on the SPY. So this is a weekly divergence. It paints the same story, but even worse. Here we have a high, tall MACD bars. We pull back. Now we're higher. No green bars whatsoever. No green bars whatsoever. It's showing you that this last move up did not have the strength of this one. We have the highs here with RSI level very high. Now we're higher. RSI levels lower. Here we get almost to the fourth ATR channel. Now we're not even to the second ATR channel. Major divergences in the market. Doesn't mean it immediately has to go crashing down, right? Don't misunderstand me. But when you do have major divergences and you get something that triggers the market to the downside, that's when it really goes down. So I'm just saying, be aware of that in your trading. Be aware of that as far as chasing things, because the technicals of the indexes, the Qs and the SPYs right now, yes, they're very strong, but the momentum indicators are showing that this move is slowing. and the indicators on the VIX is showing that the VIX structurally, from a momentum standpoint, looks very strong because they go inverse of each other. So anyway, I hope this was helpful, everyone. I really do. I appreciate you being here, spending your time. I always like to leave off with, if you could please try to go out and do something nice for someone today. It would really make the world a better place if we all did one thing per day for another person. If you could go out and do something nice for an animal as well, that would be even better. Twice as good, in fact, because animals do appreciate acts of kindness just like us humans. So again, thanks for coming. Hope it was helpful. If it was, I appreciate if you could hit the thumbs up button. If you have any comments or questions, put them in the comment section, and I'll do my best to get back. But hope you trade well. Please be careful. Get yourself a process. And God willing, I will see you next week, and we'll see what happens. But thanks again for spending your time and coming to the podcast. Thanks, everyone. And on the way out here, I have to run the U.S. legal disclaimer. Thank you. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.